Corporate tax rates have been falling around the world since the 1980s, and as countries seek to attract big foreign investors and reduce debts, there's no sign of this trend letting up. The UK just cut its rate again to 21% compared with US rates of up to 35%, and that's fueling demands for reform in the US. So the global corporate tax race has begun, but will it be a ruinous race to the bottom?
It's not obvious what's going to stop this trend. The question, is this ruinous, is one which people have mixed views on. To some extent, if you can lower your tax rate and broaden the base, you can still collect the money, and corporate tax, a very distorting tax, will do less damage to your economy. But we're into a realm where it's increasingly difficult to broaden the base to compensate for these rate cuts.
The prevailing wisdom in Washington is that the US can have a higher tax rate than most countries, but the gap's widening. A lot of businesses in the US would like to see the country adopt a similar approach to the UK and Japan, both of which moved away from a worldwide system where multinationals are taxed where they earn their profits, to a territorial system which doesn't tax overseas profits.
Reducing the US tax rate would certainly make the US a more attractive place in which to do business and to earn your profits. The US taxes the worldwide profits of its own companies, so an American multinational making profits in the rest of the world is in principle still taxable in the US on those foreign profits. However, it doesn't actually tax that foreign profit when it's made, but only when it's repatriated to the US. So it's to some extent mitigated by the fact that actually the choice of whether to repatriate those profits to the US is a choice of the company. And by and large, actually US multinationals try and keep their profits out of the US in order to avoid that additional tax.
There was a public outcry here in the UK when it emerged that multinational companies such as Starbucks were able to pay just a fraction of the tax paid by British companies. Some consumers threatened to boycott its coffee shops, so Starbucks eventually volunteered to pay the taxman an extra £20 million. But should a company be blamed for minimising its tax bill? Sir Martin Sorrell doesn't think so. The chief executive of advertising group WPP recently said corporation tax is a question of judgment, and that a company's tax return could almost be seen as part of its corporate and social responsibility statement. That particular take on corporate taxation doesn't go down well in some quarters.
The current framework of rules for taxing multinational companies is not fit for purpose. We need to move to a new framework of rules for taxing multinational companies, which takes account of the fact that a very large proportion of their global profits are now being shifted offshore through intellectual property rights and intangible goods, intangible services. And the current framework of rules simply doesn't tackle those issues. We need to have a complete overhaul of the global rules.
One of the reasons why governments are reducing their tax rates is to try and increase investment. But I think there's a more general problem here that if you take a multinational company which is operating in many countries around the world, it's really very hard. And in fact, there's really no conceptual basis at all for saying, exactly the proportion of its profits that are made in a particular country.
UK Prime Minister David Cameron has talked of a need for a coordinated global response to this issue while Britain holds the presidency of the G8. But how can countries secure revenues from corporations in a world of mobile capital?
There is agreement in the international community to fight against what we call base erosion, the fact that companies may try to plan in such a manner as the base would be reduced dramatically, the profits would be shifted to low tax jurisdiction or offshore jurisdiction with zero tax. And there, the G20 has followed an initiative by the OECD that we launched in the spring earlier, which aims at fighting base erosion and profit shifting.
The OECD wants international tax rules to be revised in a multilateral context, and it hopes to have a global action plan on corporate tax in place by the summer. But with companies still trying to reduce their tax bills and countries still engaged in a race to offer the most competitive tax rate, it won't be easy. And if the US does indeed lower its corporate tax rate, it may need to make it harder for companies to shift their profits into low tax jurisdictions. Daniel Garrahan, Financial Times, London.